Sven, let's look at the European. It appears like it's solid good news. I was saying earlier that we've had all these signals, these indicators, and the market reacts and then pulls back, wait and see. But this appears to be real good news.
I think it is real good news, but I don't think that everything's played out yet. You know, if you have a look at places like Greece and Spain, you have to, sorry, Greece and Italy rather, you have to consider sort of whether they'll even stay in the euro and whether they should stay in the euro. You know, I see that there's a party in Italy which has been gaining a lot of support now, which is talking about actually leaving the euro. And I think this is very good news because this provides a buffer if anything happens, to be able to move forward. So I think it is good news.
The point has been made that it wouldn't be all bad for those countries, and one recalls the Argentinian debt crisis of, I think, a decade ago.
Yes, yes.
Where there was a huge problem initially when they defaulted and so on, but then came economic growth, the currency then adjusted and so on. So there would be life after exit from the euro, but politically there are other factors at work.
I think there are a lot of factors at work, but definitely I agree with you. There is life after an exit from the euro. It all depends how you do it. And in some ways, it actually opens up opportunities and options for those countries. Because the problem with being part of the euro is that you can never reset your currency. So everything you do is driven by a currency which is really controlled by much stronger economies which don't really need such a weaker currency. So if you have a weaker currency, you can boost your business. And getting out of debt is not just about paying down the debt. It's about where you get your money to pay down the debt. And some of it has to come from growth.
And one thinks of both Greece and Italy in simple terms. Tourism.
Yes.
If a currency is weaker, you're going to boost tourism.
Well, exactly. I mean, that's a big advantage. And I think, I don't know the figures for Italy, but when I was looking at Greece, most people who have money in the bank accounts of Greece have already shifted it outside the country. So the average person on the street in Greece is signaling that they think they're going to leave the euro at some stage. And
the storing of baked bean tins, or whatever the equivalent in Greece is.
Exactly.
Baked lasagna tins, or whatever. But let's look at the US, and the point was made earlier that the US attention has been off them because of the European crisis, but there's still a lot to deal with there too.
Look, I think there's a lot to deal with through the world. There's still a lot to deal with in the US. One of the things that we forget about the US is we think of it as one country, and it is one country, but we forget how big it is. I mean, if you just look at California, and you split the US up, California is the 7th largest economy in the world. So the US is very, very important. But I do think that they are slowly, steadily moving in the right direction. You know, you see sort of that, you know, exports up from certain areas. Yeah, I think that the US is moving in the right direction, but there are still issues to have. Look, we came sort of in 2008 from a huge crisis, from a huge party to a huge hangover. It takes a while for all of that to move itself out the system.
So now strategically, that's what we're talking here. We don't want to look at this week. We're looking perhaps more long term, because that's what strategy should be about. How do you read this now, this bit of good news, the bigger picture in Europe? It's going to take a long time for those indebted companies to get out. The banks and the country's sovereign debt interlocked. Emerging markets in relation to this?
I think emerging markets are good. I mean, and you know, sort of we've been saying for a long time that emerging markets are positive. Emerging markets is where the growth is happening in the world. It's where the governments have very little debt compared to other countries. It's where people are moving up and having more GDP and more spending power all the time. So whether you look at emerging or frontier, we think there's tremendous opportunities there, and for a long time. But not only that, when you look back at Europe and at the US, the pension funds there used to have the system where they would have more and more younger people coming in, support the older people who are coming out, and if they didn't have necessarily this huge growth, they were okay. Now, as they realize that they need to up their growth a little bit to cater for all these people that are retiring, they're looking around for where they're going to find the growth. They realize that the growth is in the emerging markets. So if you have a look also, and you see that about 8% of European and American pensions are in emerging markets, but emerging markets are 30% of the index. And actually emerging markets as a GDP are even larger than that. You know that money is going to move to the emerging markets, so the emerging markets will grow organically, and you're going to see money flowing there. I mean, to me, if you're not positioned in emerging markets, you seriously have to look at your portfolio and think about doing something.
South Africa in the context of emerging markets?
Well, we like South Africa. South Africa is a very unusual emerging market in that it's almost like there's sort of two countries within one.
It's a schizophrenic country.
You know, we have the emerging market part and we have the developed market part. And the battle that we've had in South Africa is to allow that growth that we should be seeing from our emerging market to push through into the developed, or the developed to pull from the emerging market. Depends how you define it. I mean, I think that the government has, in general, made good decisions, but We just need to up that growth in South Africa. It's a good investment destination. I mean, we've invested in this thing. I mean, I've been investing for a decade and a half, and I've always had money in South Africa, so there's nothing wrong about South Africa as an investment destination, but we'd like to see the growth not topping out at 4.5%, but flowing through to the 6%, which we see in some markets in Asia.
And in Africa, 5%, 6% growth numbers in Africa are not uncommon. The US is 2% or so.
Yes.
We are hoping for 2.7, which is not great.
Yeah, well, look, I mean, we're hoping for 2%, but remember, that's on the shorter term. You know, longer term, I think South Africa naturally can grow at more than that and can grow faster than the US and Europe. So we do think a 2.7 is not cast in stone forever in terms of South Africa. I think there is more growth. But of course, you're right, Africa. I mean, Africa, if we get 5%, we're disappointed. You know, and you're looking at some countries are doing 7, 8% or even more. And Africa really is a growth story. But remember, it's coming from a small base, which is what enables that growth to come forward. Because every time you unlock some sort of blockage that there is within Africa, it boosts the growth. And there are blockages. I mean, drive on a road north of South Africa. I mean, there's some good ones, but there's some that you realize what the problems are. But as money comes in and we see more and more money being spent on roads and railroads, those blockages unleash. And we think that you know, as investors, you should have some of your money in Africa as well. You should have some in emerging markets, some have frontiers, and as part of frontier, you should have some of that stake in Africa, either directly or from a bigger fund.
Some of the roads inside South Africa also not so good.
Yeah, it's true, yes.
That's another subject. As a strategist, in military terms, the more you get into strategy, the less you think about the weapons, and in financial terms, the less you think about the daily numbers. You think of policy, you think of regulatory environment. The ANC Policy Conference, you must have had your eye on that.
We have had our eye on that. I think the policy conference is not so much about policy, but about actually defining who's supporting who, looking for the ANC to the future, as to who's going to lead the country. So for us, we think not much is going to come out in terms of real changes in policy.
Hence this thing about the second transition and the second phase. If that's what the debate's about, not much is going to happen.
Not much is going to happen. So it's really about who supports who. And I think that's what's important, and that's what we must watch for from this conference, rather than what the debate is in terms of the actual policy.
But what's your sense, though, and I think the market in the literal sense, it reacts, but also people who are watching react. Some of these things are priced in both audiences. They say, yes, this is hot air, and so on. But certain things may have been put to bed. The nationalisation thing seems to have been put to bed in a way that perhaps it wasn't before. Yeah,
well, I think that was almost put to bed a couple of months ago. You know, and I think the thing that we're busy talking about at the moment is if there should be some pension fund money going into some sort of national bond or something like that. You know, in some ways, I sympathise with what the government is trying to do, and I'm not for a large amount of the pension fund money being directed in towards investment. But, you know, I ask if 0.5% or something like that is spent and it's given to the IDC in terms of the bond, I mean, what South Africa actually needs in some ways is, and I'm not saying more of that, but more SASLs, more ISCORs. I know there's no ISCOR anymore, but we need to develop our industry. It must be done responsibly. We mustn't destroy our tourism industry while we do it. But I do see that South Africa can benefit from more industry.
Well, you talk about what used to be called prescribed assets. I think that's one of it. You're forced to invest in certain things, which may not be. Yeah. I've heard discussions of this where if you take the formula, the mix of investment of bonds and equities and things, it looks more responsible than just taking our money and blowing it.
Yes, I think, I mean, it must be done in a responsible way. But, you know, if in general, and I don't know if it goes into a bond or how it goes into, but if you just took 0.5% of the pensions, you put it in something that then pushed up GDP growth by 1 or 1.5%, okay, would we not all be better off at the end of the day?
Sectors in the South African investment environment, given all the things that you've said, there must be value sitting on these boards that we look at every day.
Yes, I think there's a lot of value. You know, I still sort of quite like the resources sector, especially because it's come down a bit.
It's taken a big hammering.
You know, and we're always looking out a little bit further. You know, I find it difficult to judge exactly where the stock market will go on a day-to-day basis because it's really a lot of emotion within it. But what you can look for is you can look further out. You can look at the company's earnings. You look at how good they are.
But also the old-fashioned, the price earnings thing, BHP Billiton and Anglo, 7, 8. Yes. Is this not a no-brainer for the long term?
Look, sometimes you have to be a little careful about a low PE for a commodity company because sometimes that happens when the commodity prices are high. But, you know, when we look at forward PEs for those companies of 6 and 7 times, and when we look at sort of just consensus growth for, say, BHP or Anglo American, and you look at PEGs, which is your PE divided by growth of less than 1 or just on 1, that's showing that there's value within those companies at this point in time.
So it sounds like you'll be getting into commodities.
We like commodities, but also consumers. I mean, consumers also, we think in Africa is a huge growth market in consumers, and every time they have a bit more money in their pocket, they're going out to buy something that they want to buy that adds value to their life.
Just one final comment on the financials and the banks. They went down yesterday. They went further down today, unlike the rest of the market.
Well, you know, I think it all stems from that ABSA profit warning, where they said they're going to have some more issues in terms of their bad debts. They just need to provision a little bit more. So they weren't talking about sort of end of the world scenario, but they said there's going to be some pressure on their earnings this year. And everyone is trying to figure out, how does this affect the other banks? Now, it looks like it's more of an ABSA-specific issue, but of course people are nervous, and when you're nervous and when you're uncertain, you sell first and then...
Good. Thanks, Sven. That was Sven Richter, Managing Director of Frontier Markets at RenCap.